This program is titled Identifying Troubled Companies Using Annual Statement Data. It features Eric Brandt, Senior Consulting Actuary of Pinnacle Actuarial Resources. Initially delivered to a live audience of both on-site attendees and webinar participants, the session originated from the campus of Illinois State University, and it's a collaborative effort of the Institute's Griffith Foundation, IRF, and the Cady School of Insurance at Illinois State. In keeping with the respective missions of these organizations, this session is purely instructional in nature and does not support a position on any issues.
Right, how's everybody doing? Welcome to Illinois. I'm trying to I know we have a remote audience. I know some people from Washington, Pennsylvania, perhaps Oklahoma. So we're in Illinois now, hot and humid. So appreciate you joining us in this room. We're going to talk about identifying troubled companies using annual statement data. That's a pretty big role. As a financial regulator, that's, I think, one of your bigger charges, make sure companies stay in business. No one really wants an insolvent insurance company. So I'll tell you a bit about me. I'm a fellow of the Casualty Actuarial Society, and I work at Pinnacle Actuarial Resources as a senior consulting actuary. So I don't work for a company. I work for a consulting firm. Also, I'm a fellow. That means I've passed all those actuary exams. I actually passed them. You got that credential in 2003. It also means I probably got a degree in math because I like math. So I'm one of those people. 25 years of experience, generally in commercial lines, although I've done a bit of work with private passenger auto and homeowners, the personal lines. Large amount of reserving studies, a large focus in the alternative market. And that'll come across regulators' desks a bit, especially if you have captive laws in your state. But in the alternative market, I mean these setups where the insureds retain a large amount of their risk. That could be a captive insurance company. It could be a self-insured. It could be a municipal pool, say insuring school districts or jails in a specific state or a county. And that's what I mean if I say alternative market. I graduated from ISU, I guess, a little over 25 years ago. I'm actually from the Bloomington-Normal area. And if you're from this area, it's normal to meet lots of people with insurance careers because we have a few companies headquartered here. Right now, I currently serve on two boards at Illinois State University. One is the Actuarial Science Major Board, where a bunch of actuaries help. We meet with the math staff, and then Jim is usually there and some people from the Cady School, and we provide direction on how they're doing the actuarial science major. I would say ISU, that's the one I work with the most. I'm on another board though as well. Does a great job of hybriding the insurance knowledge with the math knowledge. So people that come out generally have a good bit of both. I think that's really neat because all right, you're financial regulators, so if you're hiring someone, you would want someone to like insurance and want to have a career in insurance because that's probably what they're going to be doing. I'm also on the board of directors for the Illinois Shakespeare Festival. So if anyone's around in July, they're doing King Lear and much ado about nothing. So we're going to talk about, why would a consumer care about solvency, and just go through some of the stakeholders. We're going to talk about some causes of insolvency and interweave some real life examples. And also, feel free if you have a question, shout it out. If you're remotely, I believe Jim is monitoring questions as well. So who cares about insolvency? I have this here because we're trying to set up a framework that may even actually help us analyze. Regulators care about insolvency. If you have an insurance company that goes insolvent, you got to set up a guarantee fund, and it's kind of like landing an airplane. I've heard people talk about it. The company's winding down, so you want it to wind down smoothly. Rating agencies care about solvency. They don't want to have a company that they rate as excellent go insolvent. The investment community that invests in the insurance companies and the policyholders themselves the public, actuarial community. You know, actuaries have to opine on the health reserves of publicly available or of NAIC regulated insurance companies once a year in a statement of actuarial opinion. There's a few exceptions, but if you think of any big company, they're going to need a statement of actuarial opinion. And, you know, if the actuary says this company's reserves are reasonable and it turns out they're not, then that doesn't always look good. And the claimants and the policyholders are grouped together. If I'm in a car accident, if it's my fault, I want my insurance company to be financially robust to be able to pay the claim up to the limits I've purchased. If, on the other hand, I get in a car wreck and someone else hits me, I want their insurance company to be financially solid and be able to pay the claims to fix myself and my car. So now that we got that framework, here's a few clauses. Two of the more common ones are deficient loss reserves and inadequate pricing and rapid growth. Now, we're going to go through some slides. We're going to talk about real life examples, and you're going to see that all these examples are, usually it's a combination. So imagine this. You have an insurance company usually uses ultimate losses. That'd be losses taken to their ultimate settlement value, which Pat and Brittany will be talking about in the next presentation, but it follows this process called loss reserving. So you want to know the ultimate liability for a group of policies, and then once you know that, you use that data to prospective premium indications or rate indications. Well, if the loss reserving process itself, if the loss reserves going in are inadequate, then your ultimate losses would be inadequate, and therefore the premium and rates that you would be indicating for the forthcoming policies might also be inadequate. Everyone got that? Now, what happens? Has anyone ever seen those stories on Facebook or in the news where, you know, there's a new employee at a gas station, right? Gas is really expensive, and they're supposed to put gas in at $5.33, and somehow the computer says $2.33, right? And then it goes on Facebook, and next thing you know, that gas station is a very busy gas station until someone catches it. Insurance is like that too. So if you have inadequate loss reserves, and that's causing you perhaps to, you know, have rates that are inadequate, then people like cheap rates, it turns out. The policyholders may like inadequate rates, so you may actually experience some growth because of that. And that might lead to insolvency. Another thing with rapid growth, that can actually exist on its own. You could just have a company that wants to get into a new market. Say it's a company that writes private passenger auto. They say, hey, I'm going to try my hand at homeowners insurance. And it turns out maybe they don't have the underwriting expertise, or maybe when they set their premiums and their rates, they didn't take into account that because they were newer, they might have higher loss ratios and things like that. So, and there's other reasons that we'll go into, but rapid growth and often inadequate pricing. Other ones are catastrophic risk. I have an example of that. So offsetting this rapid growth thing, I know I'm talking in circles. Diversification can be important in that it is good for an insurance company oftentimes to focus on one line or one state. And there's several that do. It's usually specialties. But then if that special line in that special state has a bad loss year, it can cause companies to go insolvent. So that right there is an argument for, you know, maybe diversifying your state line mix. Obviously, at the end of the day, it comes down to expertise. Jurisdictional risk and failure of a reinsurer. So there are reinsurance contracts out there. Sometimes one company thinks a reinsurance contract is going to behave differently than the reinsurer. And sometimes that's settled in courts. It can be settled in arbitration. But what that means is several years after perhaps a reinsured event happens, the company may go insolvent. Any questions on those? Any comments? Any notes from experience? And I have a few real ones here. I got the companies written down on my cheat sheet. But Company A, between 2017 and 18, they experienced adverse loss reserve development. What that means is the loss reserves they had on their yellow book for years 2017 and prior, between 2017 and 18, it turns out they were inadequate, and they had to post more money to cover those losses. Consistently underestimated its actual losses and failed to establish adequate reserves for those claims. Eventually, it caught up with them, they went insolvent. Company B. Now, this one here is, I think, good for the regulator, because I know a lot of the regulators in the states are going to have specific rules and maybe ratios, and, things that trip certain tests or perhaps trip financial exams. Company does not have admitted assets equal to all of its liabilities, together with the minimum surplus required by the state, and it doesn't have liquid assets to meet its next 90 days current obligations. So we're going to talk a little more about liquid assets later. But does everyone here know what liquid assets mean? Right. Because that means you can pay it right now. Like cash is very liquid. Cash is also expensive. An insurance company can't say, oh, I'm sorry, your house burned down. Can I wait 180 days to pay your claim so I get the best yield out of my bonds? And insurance companies can't do that. So that's what they mean by liquidity. Company C, this is one of those monoline, mono-state companies. This was a small company in California that underwrote homeowners insurance in California. And, or at least that was their major line. I don't know if they're, for a fact, they were monoline, but I know that's generally what they wrote. And then they had the campfire. And it burned down a bunch of houses and took the company down. So Company D, this is reinsurance. It had an accounting error related to its 2008 and 2011 catastrophic reinsurance treaties. That could mean the yellow book was wrong. It could also mean that maybe they got in an argument with the reinsurer and things didn't end up the way they thought. So the cost of fixing errors and the operational loss in 2013, the company told the state regulators they're going out of business. Now, remember, this is the fourth quarter of 2013, and one of the key factors related to the insolvency were reinsurance treaties related to a 2008 event. Okay. Any questions? So these are real life examples that we called out. There's more. We are going to get into some numbers, so I'm getting everybody prepared. Okay. So, Schedule P of the annual statement and the statement of actuarial opinion contain detail on net and direct reserves. So, net and direct reserves, direct and assumed reserves are all reserves for insurance underwritten by a company and assumed from other companies. And then if they cede reserves to reinsurers, direct minus ceded equals net. So net is after all the assumed effects of reinsurance, direct is before that in general. Schedule P of the annual statement, is everyone out here familiar with Schedule P? Okay, yeah, so Schedule P is that's one schedule that actuaries use. It has a lot of reserve detail and IBNR, incurred but not reported reserve detail by line, by accident year. It's the only thing, I believe, by accident year in the annual statement, or one of the only things. And I like that because actuaries are one of the only professions that looks at data by accident year. And along with Schedule P and the other schedules in the annual statement, the NAIC has the Insurance Regulatory Information System Tests, also known as IRIS. We're all familiar with those, right? All right, so here they are. So, we have a real life example embedded in here. So, there's 13 IRIS tests right now. I have trouble saying that because when I was taking my actuary exams, there were 12. They added another one in there. You can see they have different groups. There's liquidity, growth, reserving tests, and some profitability tests. I know the last three, the 1 year and 2 year development to surplus and premium deficient or reserve deficiency to surplus, all three of those have to be looked at as part of the statement of actuarial opinion. Triggering a number of these, that is exceeding or going over or under a critical value, may trigger regulatory scrutiny. So in this example, in 2016, this company triggered 6. In 2017, they triggered 5. And in 2018, this company triggered 11. So the threshold, I believe, is around 4 or 5. If you see that, it might be worth talking to the company. Now, just because there's a critical value of an IRIS test does not mean a company is going out of business. There's lots of reasons to have critical values for an IRIS test. For example, there's the gross premium and net written premium to surplus, the change. That measures growth. A new company may well exceed those. A company that is really ramping up business may exceed those. Now, I just told you rapid growth is a leading cause of insurance solvency. So as a regulator, if you see a company that may get critical value for test 1 or 2, you may want to talk to them about their growth and just get comfortable with the fact that they are doing it properly. Maybe, like I said, have the proper underwriting in place, or maybe accounted for a little bit higher loss ratio if it's a new line they're entering, and that way, if they're trying to compete with experts, they're not undercutting them. If IRIS ratio 4, the surplus aid to surplus, is unusual, then you can adjust it, recalculate it with an adjusted surplus, I believe. Surplus aid has to do with how a company can use specific kinds of reinsurance to write more business, quota share in particular, I believe. So it's basically a way to monitor that company isn't trying to leverage a lot of reinsurance to write, I guess, poor quality business. And some other ones here, we have agents' balances. You have an agent that underwrites a lot of business and they don't send you the money, and then the agent disappears, then you're out that money. And these are the ones, several of them that are that had critical values on these. Change in surplus is another one on here. So that right there says, who cares about insurance solvency? Some real world examples and IRIS ratios. We're all fairly familiar with those, right? Do we have any questions or comments at this time? Okay, well, now I'm going to go a little bit beyond IRIS. So I use a lot of the annual statement. I like looking at the annual statement as part of my job. So we have some tools, and a lot of these are used by a lot of actuaries. I actually talk to a lot of regulatory actuaries who speak on this at actuarial meetings. So as we present these ratios, maybe you want to add these to your tool chest. So, for example, and on this slide, I should say, and as we go, a lot of this is also trying to find rational explanations for IRIS ratios. So sometimes you find an IRIS ratio with an unusual value, and then you're trying to figure out how to diagnose it. And as I said, premium growth with good rating and underwriting may be good. A company expanding into new lines by hiring expertise from a competitor, or or maybe someone out of retirement. I know of one of those recently. That kind of be a wise decision. And if a company does find itself with deteriorating financials, they can always increase their rates and perhaps make their underwriting a little more stringent and wind themselves out of it if they catch it on time. So Schedule F, Part 3 in particular, lists reinsurance recoverables from each reinsurer. So in the statement of actuarial opinion, what we have to do is we basically have to have some sentences, usually along the line of, I have reviewed the reserves recoverable from reinsurers. I have reviewed to make sure no recoverables are more than 90 days late. I have reviewed their financial ratings from so-and-so. You can pick your favorite financial rating agency. The point is the actuary will say, hey, we are assuming that all reinsurance is valid and collectible. That's a common sentence. It's not always the case. However, so we make this list, we take the reinsurers, we list them, and we will try as best as possible to populate it with current rating value bureau information. So maybe there's reinsurance recoverables from 10 companies, and 9 of them are rated an A or higher by AM Best, and 1 company is rated C. Well, we have a spreadsheet. We try to figure out as a percent of surplus what the recoverables are. In this case, probably the amount of recoverables for the company rated C over surplus, and see if it would be material. If it is material, you could expect extra language on that. And even if a company is rated A, if there were substantial amounts of reinsurance recoverable on reserves that's overdue or perhaps in dispute, you would expect extended commentary on that. We don't go in and analyze the companies, but we are using publicly available data, and mainly, in this case, AM Best or whatever other rating agency you have, combined with Schedule F Part 3, and that's just to give an assessment of their reinsurance recoverables. And when I mean on reserves, it's recoverables on claims that have already happened. So here is an example of this right here. So in this particular case, all the reinsurers are labeled A. There was one we couldn't find, it was not rated. However, not rated, it's 2.3% of surplus. So we might declare that to be immaterial, or to the opinion. Now, again, if you pick the company like Reinsurer E that has a pretty substantial amount of reserves that are recoverable, then we would have extended commentary here as well. And one thing you may ask in this case is where am I focused on the letter A? I mean, I got B's in college, right? But for reinsurers, and Jim, and I know you know this, correct me if I'm wrong, I don't think I am. Going from an A to a B is a big deal. In fact, going from an A minus to a B plus is a big deal because, especially for commercial insurers, a lot of commercial companies, the big companies that buy the insurance, they have to buy their insurance from an A-rated carrier. And they're going to demand that across the whole stream of insurance and reinsurance. So if a company goes from A minus to B plus, that can have substantial ramifications and cause a lot of market shopping. Any questions on Schedule F? Okay, diversification. I promised you an example. This is real. This is what I did in my formative years. It happened in 2000. It really doesn't matter, though, when it happened because these numbers are real. Okay? This is a company, it wrote medical professional liability in New Jersey and Pennsylvania. And its loss ratios were 34 and 44%. So, the term loss ratio should never be used without a license. So here, I'm going to throw the license. When I say loss ratio, it's going to be the amount of loss and loss adjustment expenses paid out per dollar of claim on an ultimate basis, okay? 34 and 44%. So this company decided to grow. Maybe they were tired of just writing in Massachusetts and Pennsylvania. So they wanted to grow. And remember, I've talked about this a lot, except growth turns out to be a major indicator. So we kind of got to talk about growth. It can be good with good underwriting. That means you grow and you know what you're doing. However, when you go to a new area or a new line, there's an increased risk of poor underwriting and inadequate pricing, right? And I said, if you have inadequate pricing, sometimes that can cause you to grow even more. That can also be called the new business penalty or adverse selection. This company grew strong in the late 1990s. Unfortunately, I was in my formative stages of my career in the late 1990s, but loss ratios were generally high. It was at the peak of an underwriting cycle, and poor underwriting results. They also had large amounts of adverse selection, or adverse development rather, materialize. And what that means is, they underwrote this business. They probably wouldn't have grown if they knew the market was going to have poor underwriting results, right? But they did. And sometimes that happens. But the thing is, when they were probably setting their reserves for their open claims, they didn't realize how bad the market was going to be, because it takes time to realize sometimes how poor an underwriting period can be. So as they kept filing yellow books, say 97, 98, 99, they kept having to throw more dollars in these policy periods for their growth. So here is the rest of the table, okay? So in New Jersey and Pennsylvania, which accounted for roughly 32 percent of the market share in these states, they had loss ratios that were 34 to 44%. However, let's look at the states they expanded into. Florida, they wrote $15 million of premium and had a 157% loss ratio. Illinois, $5 million of premium and 121% loss ratio. Down the line, they did pretty well in Missouri, 77%. I mean, not perfect, but it's under 1. That's good. And Texas, it was 134%. These loss ratios are over 100. That means they're underwriting for every dollar premium, they're paying out more than $1 in losses. You can't really go on that like that for too long, right? So this company went insolvent. But this is a diagnostic. I believe it's going to use a combination of accident year losses. Actually, these loss ratios aren't accident year. These loss ratios, I believe, are calendar year because they're by state. That would be statutory, I believe, page 14 of the annual statement, exhibit of losses and premium by line of business. Any questions so far? So example 3, I'm going to try to describe it as much and a fair amount of detail. This was actually the example that precipitated this whole presentation. It used to be about 20 slides. I got a few less slides here. So we talked a bit about reserve development. There are some IRIS tests, but the IRIS tests are very simple tests. I've spent a lot of, 25 years of my career, most of it in loss reserving. So I don't want anyone to think that a 25-year career can be condensed in a couple ratios. Now, the IRIS ratios themselves are good because the information is publicly filed on these annual statements. That's one reason the IRIS ratios exist. The companies have to file the annual statements, so they have to make the IRIS ratios. But sometimes you need to go one step further. The IRIS ratios rely on a company's estimate of IBNR claims incurred but not reported. That's an amount of reserves added to the company's held case reserves, and that is the ultimate reserves to pay out all the claims that have happened on the policies they've underwritten. Now, obviously, the process I described, it's not a full-blown reserve analysis. Those can take days or months for big companies. And right, a lot of times we may not be talking to the company, but we are using publicly available info. A lot of that's annual statement info. Some other may come from write-ups from reading agencies. So We're going to use a lot of Schedule P. Schedule P shows data by line and historical accident year evaluations. We're going to hear a lot about that in an hour. But what it basically says is that if a company has 10 million of ultimate claims on a group of policies that's effective, say 12 months old, what does it look like when that group of policies is 24 months old? And 36 and 48. It gives you 10 years of that, and that allows actuaries to project IBNR, that additional amount of reserves needed to pay claims. And I don't want to steal anyone's thunder. I'll just give one quick example of IBNR. Because IBNR is real, it's important. If a company does not budget for it, you may want to make them budget for it, or perhaps put them out of business. But if a company has a bunch of claims, say they write a liability, right? There's lots of liability claims, and not all of them settle for $1 million, right? So let's say it's $1 million limits, we're just going to keep it simple. However, there's a chance some of them will settle for $1 million, and some of them will just settle for defense costs. What do you want? What as a regulator, what do you expect your claims adjusters to do? They're not going to reserve every claim for $1 million. Worst case scenario, that would tie up way too much capital. However, the claims adjusters will decide, maybe they'll reserve every claim for, on an average of $25,000. And then the actuaries will look at numbers and determine historically, the mix of claims that settle for, lawyer costs and the ones that pop to $1 million, and then they'll try to project out the amount. Usually those amounts do go upward over time, and sometimes substantially. From my experience, a lot of times between 5, 6, 7, and 8 years, that's a lot of times when verdicts happen on claims if they go to court. And then the question is, with the IBNR, do the company's financial, do they budget enough money to, for its unpaid losses? So unpaid loss is another way to say loss reserves. And we got more details are coming up. So here's what's going on. This company, we were actually contacted by a professional board. This was a lawyers group. We always talk about medical professional liability insurance. I'll tell you, there's actuaries professional liability insurance out there too, and lawyers professional liability insurance, and architects professional liability insurance. That's a great example of one of those lines where your claims could be 0 to $1 million easily, right? And this trade group had a company that they were telling its board members was one they could buy this insurance from. And for some reason, they wanted someone to figure out if the company is financially doing okay. So that was our assignment. And we took to it. Now, this company was part of an insurance group. So there was some medical professional liability writers predominantly, and this lawyer's professional liability writer. I believe there's 4 or 5 companies involved. I think 4. The problem with a group is, even if you're the best performing part of a group, if there's another part of a group that's performing poorly, what can happen? If they're pooling all their losses to a parent, then the poor performing group can bring the whole thing down, right? So here are some medical professional liability claims made numbers they came up with. We have the incurred losses, if you can see my pointer. So the incurred losses are here. This is amounts paid and the case reserves. So reserves assigned to pay outstanding claims by the adjusters by accident year. So by accident year, that means the year the claims happen. The policy, or the policy year that it would pay out on. So the year the claim was made in this case, this claim's made. selected ultimate losses, that's what I did. I ran this company's 10-year Schedule P and looked at how the incurred losses were changing over time. So here, their incurred losses were $44 million, and I said, based on looking at this thing called the actuarial loss triangle, that they'll ultimately settle for about $99 million. The ultimate minus the incurred, I said they should have around $54 million of IBNR. Now again, this isn't really a perfect reserve analysis in any sense. I'm going to tell you that. It was made by annual statement data. I did not have meetings with the company. I was using an annual statement. Although there's, 3,000 property casualty insurance companies out there. That's a lot of meetings, folks. This is just something to look, because you're trying to look for places. Your time's valuable. You're trying to figure out where to dig. The company was holding $20 million of reserves for that accident year. Or $20 million of IBNR, rather, sorry. Similarly, in 2000, the incurred losses were $46 million. But it's more mature. So my ultimate indicated losses were about $70 million. So I was saying this company should hold about $24 million. The company was holding 11 of IBNR. And I went back every year and did the same exercise. In fact, the oldest year they were holding 0 of IBNR, I had 620,000. Long story short, though, my back of the envelope reserve calculation said that they were holding around 59 million less IBNR than I thought. That could be a back of the envelope calculation, and this is for one of the MPL writers in this group. But that calculation would cause me to want to go in a little further, okay? We also looked at some MPL occurrence. So this is actually on a group basis. So this is the whole group's medical professional liability portfolio. We looked at their occurrence. They write a lot less occurrence. Now, occurrence policies usually have a bit more IBNR associated with. Sometimes they develop the ultimate slower because claims can come in a lot further down the line. You know, in claims made policies, theoretically, all these incurred losses, the book of claims never changes as it matures, because after 12 months, you know all your claims. So the entire difference between the incurred losses and ultimate losses, that's changes in how the claims are settling. Whereas with occurrence policies, you can have true IBNR claims. That means 5 years from now, there could be maybe the example, right, I always heard at school is the person goes for surgery and the doctor says, whoa, something went wrong on a surgery 5 years ago, and then there's a claim against a medical malpractice occurrence policy that was 5 years ago. Because on occurrence, it would go to the date of the surgery, not the date the claim was made. We clear there? So at the end of the day, we ran this reserve analysis on their occurrence policies and found $32 million difference. In fact, they were holding 2.8 million of IBNR, and I was recommend, my back of the envelope said 35 million. And this was based on the company's own development. So there were some differences that I found through a fairly rudimentary loss reserve analysis. That itself doesn't mean anything, but it means that we may want to investigate further. Now here, this is the professional liability writer itself. So this is the company that we were paid to analyze. So here we found on an occurrence and a claims made form some shortfalls, but relatively minor shortfalls, or deficiencies in indicated reserves. That's normal. Nobody's going to agree on reserves, and when you have an actuarial estimate of reserve at a point in time, it's going to change by the next point in time. But you want to be within a certain tolerance. Relative dollar amount, this 182 and 170,000 relative to the medical professional liability, it's not a lot of money. and the company has $5 million of surplus. So if they were short, these two combined about $350,000. So let's say I was right. I'm not even saying I'm right, but let's say I'm right. They have to post an extra $350,000. Okay, but they got $5 million of surplus. And that's, I would say, by any measure, an adequate amount of surplus. So Schedule P is good. It's publicly available data. So to the extent the data is imperfect, and that's a topic for a whole other presentation. No source of data is perfect, but Schedule P is publicly available. It's filed with you. It can be audited. In fact, the actuarial opinion, we got to do a Schedule P reconciliation to reconcile the data from Schedule P used in the actuarial analysis. It breaks down companies' reserves into into several lines of business. And because it's electronic, when we get data from AM Best or SNL, you can usually do quick analysis. The other thing, it's easy to analyze groups. So I was able to get this data on a group basis instead of looking at the 4 individual companies. That came in pretty handy as well. And that's something. Now, the yellow books are submitted for each statutory company. However, the electronic data vendor, it allowed it to aggregate it. So here are some pitfalls of Schedule P. I want to make sure I get both sides. It's restated for lost portfolio transfers and novations in the past calendar year. Well, that's a fancy way of saying Schedule P from one yellow book may look a bit different than another yellow book that's historical years may be restated. Other liability is not broken down by sublines. So when I said we looked at other liability, that's what it was. We're assuming most of it, I believe, was employer's professional liability, but medical professional liability is broken out separately, but everything else is this other liability. It does not break things down by state. Very significant for workers' compensation or state-specific liability writers. I'd say property writers as well. So very limited information on A&O reserves, and it's much easier to do a net analysis than a direct analysis. Now, over my years, I've come up with ways to attempt direct analyses on Schedule B and things like that. But we do recognize that there's limitations. One reason you do want to look at net and direct is most companies do have reinsurance. And the primary insurance company is going to be liable for its obligations in case the reinsurer fails, right? So reserves and premium growth are looked at on a direct and assumed and a net of reinsurance basis. Generally in actuarial analyses, I know a lot of the IRIS ratios as well. So here's what ended up happening. As we go here, I want to make sure. Okay. So this insurance company, we looked at more ratios. We went in deep. We went into the balance sheet. We found, I believe, some surplus infusion. Some surplus was added to help pay reserves between years, and we told this company that they really might want to look into the, something might be wrong with this group. Now, at the end of the day, this group was actually shut down by the insurance department, I think within a few months of us doing this analysis. No, we never really contacted anyone in this group. We did this all using annual statement data. It turns out there was a few nefarious things going on. I believe some people that were involved in this group got into some legal hot water. That happens, unfortunately. It happens sometimes with insurance and reinsurance transactions, and sometimes this happens with banks. If things aren't going well, sometimes you try to grow yourself out of it or do more risky things. I know that's something as regulators you watch. So what that was is that was a case where The professional liability writer looked good, but it was part of a group with these medical professional liability writers that were writing business. They were not holding enough reserves. They had very high loss ratios. And at the end of the day, that business took the whole group down. Insurers fail for a variety of reasons. So we gave some examples, but a lot of it has to, like I said, growth, rapid premium growth, and inadequate reserves happen a lot. But yeah, every time a big reinsurance company fails, usually some other insurance companies fail. A good regulatory system will have several different types of metrics to test for, on areas to investigate. So again, I would suggest that some of these tools are, so you can start with IRIS ratios, but if a company is having critical values on a number of them, just developing tools to go a step further. I, as an actuary, am biased. I say Schedule P comes in pretty handy. Again, I've found a way to do a fairly quick back of the envelope reserve analysis that may indicate that the reserves might need a quicker look. And again, so these metrics combined with knowledge of the company may help identify troubled insurers.
The Institute's Griffith Foundation, IRF, and the Cady School of Insurance at Illinois State University thank Mr. Brandt for sharing his insight. To learn more about forthcoming Griffith Foundation programming, please visit www.griffithfoundation.org.